Okay, so as I was saying the other time, I think we have like three formulas for cost of equity according to what you guys gave us at that time. But look at the requirements. Estimate the weighted average cost of capital of Double Star PLC without the finance director's recommendation. So we need to read through this question first to understand the finance director's recommendation. Are we on the same page? Okay. The ordinary shares have a current market price of 3 naira 50 kobo each on 28th of December 2017. The dividend for 2017 of 70 kobo per share was proposed on 25th of November 2017 but was paid on 30th of December 2017. Dividend per share in the preceding year were as follows. Okay. You have 2012 dividend, which is 45 kobo, 2013 dividend, which is 50 kobo, 2014 dividend, 55, and 2015 is 60. Dividends are paid once a year and are expected to grow in the future at the same rate, at the same annual rate as they have since 2012. Okay. Preference shares have a market price of 0.8 naira each. The 2017 preference dividend of 12 kobo per share has just been paid. Dividend on the preference shares are paid once a year. The convertible debenture stock has a market price of 120 naira per nominal. The stock is convertible into ordinary shares in 5 years' time at a rate of 100 naira nominal stock for 50 ordinary shares. The market price of the shares at the time of conversion is expected to be 4 naira each. If not converted, the stock will be redeemed in 4 years' time at a price of 125 naira. Okay. The unsecured loan stock has a market price of 80 naira and is redeemable at par in 6 years. In 6 years' time. The market price of the redeemable bond is at par. The company has just paid the interest for 2017 on all bonds except the redeemable bond. The company pays corporate tax at rate of 25%. The shareholders complained bitterly on the 2016 dividend of 64 kobo as it was lower than what other similar companies paid as dividend. The finance director, now this is where we are coming to. They said we should estimate the WACC without considering the finance director's recommendation. Let's see his recommendation. Are we together? The finance director is not satisfied with the cost of capital figure calculated, and he believes that capital assets pricing model CAPM is preferable to the dividend valuation model approach. He is also of the view that the Gordon's growth model of growth will be adopted in determining the growth rate associated with the dividend. The average market return over the period is 23%. Return from treasury bill is 8%, while the systematic return of the company has just been estimated to be 120% of that of the market. That's better. The company usually reinvests its retained earnings. They have a payout ratio of 24%, and the average return on investment is 25%. Okay. Are we clear on finance director's recommendation? Hello. Please, if you know your background is not
Clear.
not noisy, you can unmute yourself. Okay. Okay. Person that said is clear. Can you explain what the person is trying to pass here? The message. Hello. Someone said it's clear. So let the person explain the message of the finance director here.
Yeah, the finance director is trying to say that it's better for the company to use the CAPM model to calculate the dividend, the company's WACC. Now they
Okay.
could get the cost of equity and the rest. So that is what I could get there. So according to the question, I believe that we are not going to use CAPM, since the question says you should not consider what the finance director said.
You are very correct, sir. So if you look at it, the finance director states that CAPM approach is preferable to dividend valuation model, which means in this A part, we are to use dividend valuation model for cost of equity. But if you look at the B part, the same examiner now wants us to now recalculate cost of equity, but now using CAPM as advised by the financial director. Okay, so let's go. We have three formulas. Obviously, there is growth in this question. So we are going to use the dividend valuation model formula, the one with growth. So we say KE is equals to DO into 1 plus G over market price per share X diff plus G, everything multiplied by 100. So we need to get each of these variables. Okay, so let's go back to the question. KE is equals to okay. So our dividend for this is 2017. Can we see my screen?
Yes, sir.
So it means the year we are dealing with is 2017. So we look for a dividend of 2017, which is 70 kobo per share. Are you on the same page? Which is 70 kobo per share. Okay. So we go back to the solution and say 0. Let's work in error 0.7 naira into 1 plus G over market price 10 plus the G. Okay, so let's go back. We need to calculate our growth rate. We need to calculate our market price. Okay, since we are to use dividend valuation model and we have two methods of growth, we have the dividend growth model and we have the Gordon's growth model. So we use dividend growth model here because from this requirement C, it's obvious that the examiner wants us to use dividend valuation, dividend growth model because we are told to still use Gordon's growth model in C. So which means in B part, we are to use dividend growth model. Okay. So quickly, someone should help me with the formula of growth rate using dividend valuation model. What's the formula again? N minus 1 square root of latest dividend over earliest dividend, everything minus 1. Am I right?
Yes, you are right.
Okay, so what's our N? You know, if you are using this formula of
right.
N minus 1, N will mean number of years. If you are using N minus 1, but if you are using N alone, it will mean number of growth. So number of years. Let's go and check the available information. Okay. What is the earliest dividend? Or let's check the range first. We are now in 2017. So what is the earliest years? We have 2012, 2013, 2014, 2015, and we have 2017. So it means our range is from 2012 to 2012 to 2017. Are you on the same page? So let's count how many years? 2012, 2013, 14, 15, 16, 17. That should be 6 years. Am I right? Hello?
6 years.
Yes,
sir.
you are right. You are right.
Okay, please, I need immediate feedback so that we know that we are on the same page. So we say n, which is 6 now, minus 1, then root. We need to look for the latest dividend and we look for the earliest dividend. So latest dividend is dividend of 2017, which is 70 kobo. Latest dividend, 70 kobo. Earliest dividend, that should be 2012, 45 kobo. Are you on the same page? Hello?
Yes, we're on the same page.
Yes, sir.
Are you on the same page? Or am I on my own?
Yes. No, we're on the same page.
We are together, sir.
Okay. We go back to the solution book. We say 70 over 45. Then whatever we have, we say minus 1. You do fifth root of 70 over 45. Whatever you have, minus 1. What do we have? It's let's confirm figure. Press the calculator and help us with the figure. What do you have?
0.092.
Sorry, come again.
0.092.
Let's confirm figures, please. You first do 70 divided by 45. Whatever you get, you now take fifth root of that figure. And after that, you now minus 1. Okay. Any other results?
It's correct. 0.09.
0.0 what?
0.092.
Like this.
Yes.
Okay. So which is 9.2%, if your figures are correct. Okay. Press your calculators now. I don't want to go far. Someone will now tell me so figure is not correct. I won't listen. I will tell you to go and recalculate it first.
Question. Can you hear me, sir?
I can hear you now.
Okay, so my question is, how do we know when to use n minus 1?
Please, who is sorry, 1 minute. 1 minute. If you know your background is noisy, please don't even try to unmute yourself. Please. Okay, I'm with you. You can continue with your question.
Okay, my question. Okay, thank you, sir. My question is, when do we know to use n minus 1 and when do we use n when calculating our growth rate?
Okay. The thing is that it depends on your interpretation. If you take n to be number of years, then you check the years range. But if you take your n to mean number of growths, then you know the growth range, which means your own formula will now be n, not n minus 1. From this question now, if you should interpret n as a number of growths, you are going to have 5 growths. Are we on the same page?
Oh, yes, I'm with you, sir.
Okay, so it depends on your interpretation of n. If you say n is number of years, you know the formula should be n minus 1. Then you check the years range. Then if you say your n is number of growths, so it means your formula is n, not n minus 1. Then you check the growth range. Are you on the same page?
Yes, sir. Thank you very much, sir.
You're welcome. So our growth rate is 9.2%, 0.092 plus 0.092. Okay, so we need to get the market price per share. let's go back to the question. Okay. Quick one, look at it. It's here. Let's take it again. I want you to respond, please. Someone should tell me the market price per share. The ordinary shares have a current market price of 3.5 naira each on 28th of December 2017. The dividend for 2017 of 70 kobo per share was proposed on the 25th of November 2017, but paid on the 30th of December 2017. Dividend per share, okay. So who can tell us what is our market price per share now? Anyone? Madam Okezi. Madam Okezi, this is the last time I'm going to be warning you, please. Your background is very noisy and it's not good at all. Kindly mute yourself if you are not contributing to the class, please. Okay, someone is speaking. What's our market price per share?
3.50 kobo.
Okay. Now, that's the market price per share. My question is that, according to the formula, our market price per share should be X div. X div. So that 3.50 kobo, is it X div market price per share or cum div?
It is cum div.
So how do you know that it's a cum div from this question? How do you know that it is cum div?
Because they said the dividend for 2017 of 70 kobo per share was proposed on the 25th of November, but will be paid on 30, which means that they have not paid it yet.
Okay, so let me explain further. That price, that 3.50 kobo was declared on 28th of December. Are you together? But they finally paid the dividend for that 2017 on 30th of December. So it means this figure is before the payment of dividend. So for us to get the X div market price, we need to deduct the current year dividend from the market, from the cum div market price. Okay, so quick one, we go down, we say X market price per share X div is equals to market price per share cum div minus dividend per share. So we have 3.50 kobo, right? Minus 0.7 naira. So what will this give us, please? Is that 2.8? Is that 2.8?
Yes, sir. Yes, 2.80 kobo.
Okay, so let's go back.
2.8.
We come back here, we say over 2.80 kobo. So what you do 1 plus 0.092, whatever you get, multiply by 0.7. After that, you divide your result by 2.80, then you add 0.02 to it, then you get your result. So final figure, how many percent is our KE? Let's press our calculator. How many percent is our KE, please?
%36.5%.
36.5%.
Yes.
Okay, please let's confirm figure.
Yes, 36.5.
So we go back to the table. We are done with cost of equity. Under the cost of equity, you put 36.5%. Okay. So we are done with the cost. We go to the value now. Okay, so what's the value? What's the formula for the value of equity? Anyone? Market price per share x div multiplied by number of shares. Okay, our market price per share x div is 2 naira 80 kobo. Number of shares. Let's go to the question. How many shares do you have in this company? See it here. We have 500 million naira worth of equity. Then it is 1 naira per share. So for us to get our number of shares, we will divide this book value over par value. Okay. So you say 500 million divided by 1 naira, which means you have 2 naira 80 kobo multiplied by 500 million shares. Somebody should do the calculation. What's the result? Let's work in million. How many million do you have? Wait, you know.
Yeah. 1,400,000,000.
1.4 million.
Like this, right?
Yes.
Okay. So immediately, these are market value of equity. We go back to the table. We put that there. $1 million. $1 million.
Hello, sir.
Yes, I can hear you, sir. Any question?
It's like you say we have to work with a million in millions. That is 500 million by 2.8. It's not 1.4 million.
So it's what, sir?
It's billion.
And it's still the same thing now. Maybe it's per million. Million is on top of it.
We are suspecting 6 zeros correctly. Did you get? Okay, so
Yes.
now we are done with equity. Let's proceed. Okay. Any question on equity before we move to another source of capital? I think we are all good on this.
Yes, sir. Sorry, sir.
Okay.
I have a question, sir.
Question, ma'am.
Yes, sir. You were explaining something about the number of the hen in the growth rate.
Yes, ma'am.
Yes, sir.
Were you around last class?
No, sir. I was not around. This is my first time.
Okay.
I just joined the group not quite long.
Okay. So N in that formula, people that were around, I know, I think we have an understanding of that. N simply means in some textbooks, the reason for that is, let me write it here. In some textbooks, you will see this formula that G is equals to N square root of latest dividend over earliest dividend, everything minus 1. Why you will see in another book, you will see another formula, G is equals to N minus 1 latest dividend over earliest dividend, then minus 1. The difference between the two is that N here in this first formula is number of growths. Why this other one has minus 1 is N means number of years. Okay, so I have to bring that out.
Yes, sir.
Before I will end up doing this one alone now, somebody will say they have another textbook whereby they see something like this other one. So, for example, just like this our question now. 2012 to 2017, I think. If you are to calculate number of years now, number of years is going to be 2012, 13, 14, 15, 16, 17. That's 6 years. 2012,
Yes.
2013, 2014, 2015, 2016, and 2017. If you count it one after the other, this is 1, 2, 3, 4, 5, 6. 6 years. So N will be 6 years. Then you say -1. So if you are using number of growth like this guy here, you check from 2012 to 2013, you have 1 growth, 2 growth, 3 growth, 4 growth, then the 5th growth. So here N will be 5 here. Do you understand now?
Yes, I do, sir. Thank you very
At
much,
the
sir.
end of the day, you see that both of them are actually 5. So it depends on your interpretation. If you are saying number of years or you are saying number of growth. Okay, so let's proceed. We are done with this aspect. Okay. The preference shares have a market price of 0.8 naira each. Okay. Market price. The 2017 preference dividend of 12 kobo per share has just been paid. It means, because of this statement now, it means this market price of preference shares is X preference dividend. Are we on the same page? So dividend on the preference shares are paid once in a year. So we go back to the solution. We pick preference shares now. Preference shares. So we are starting with its own market, whichever one, be it market value or cost. Okay, let's say C. Let's say cost of preference shares. So what's the formula? KP is equals to what? Somebody should help us out. KP is equals to what? Anybody? We said KP is equals to
dividend. Preference share dividend over market price.
Sorry, I didn't get that. Preference share dividend. So how do you calculate preference shares dividend? Preference dividend rather. So it is fixed percentage multiplied by the par value, then this one alone like this guy is what you call the preference dividend. Are you on the same page? Then divided by market price per preference shares x preference dividend, then multiply by 100. So I hope the formula is clear.
Yes, sir.
This percentage, when the examiner states preference shares for you, they will put a particular percentage at the front of that preference shares. That's what we're referring to as percentage here, fixed percentage. Then the par value, examiner will tell you the par value. Multiply it together to get a preference dividend. Then over market price per preference shares dividend times 100. Let's go back to the question to pick those variables. We are told that the preference shares have a market price of, okay, this market price per preference shares. And the 2017 preference dividend of 12 kobo per shares has just been paid. Now, you're lucky that you're given this prevent dividend. But if you're not given this, how to calculate it, you go to the table. Okay, these are preference. This is the preference shares aspect. So what you do is that this 12%. Can we see my screen, please?
Yes, I can see your screen.
Yes, we can see your screen.
This 12% here, this is the fixed percentage. Multiply by par value, which is 1 naira. When you do that multiplication now, that is 12% times 1 naira. It will give you 12 kobo. Okay, so that's what examiner stated here. Okay, so you come back. Either you put it as 12% multiplied by 1 naira. Then I think this one should be 0.8 naira. Let's reconfirm. Yes, where is it? 0.8 naira. Okay. Whatever you have here, multiply by 100. What's the figure, please? How many percent?
15%.
15%.
15%. Now we have the cost of preference shares. So we go back to the table, we drop that there. Because it's 15%, it remains the market value. Okay, the market value formula remains the same. Market value of preference share is equals to market price per preference shares x diff multiplied by number of preference shares. If we look at the number of preference shares, this one is 0.8, I think, multiplied by, let's check the table. Preference shares, how many? Preference shares, you have 100 million naira. But we don't need the naira, you don't need the book value, we need the number of preference shares. So you divide it by your par value, which is 1 naira here. So you go back to the calculation, you say 100, right? $100 million over 1 naira. So that will be, I think, 80
million.
80 million, right? So that's our market value of preference shares. Okay. This is 80, right? Okay, so let's go to the question. We are done with this guy. We are done with this guy. Preference shares. Okay, let's proceed. Okay, we are done with this guy. Now we are here. The convertible debenture stock has a market price of 120 per nominal. The stock is convertible into ordinary shares in 5 years' time. So which means if you are using conversion option, you have your number of years is 5 at a rate of 100 naira nominal stock for every 50 ordinary shares. Okay, the market price of the share at the time of conversion is going to be 4 naira each. Okay, this is the conversion option. This is all this false information is if you have to convert. Then if you plan to redeem now, if not converted, the stock will be redeemed in 4 years. Please, you have to take note of this. If you are converting 5 years, if you are redeeming 4 years, at the price of 125 naira. So a quick one, Who can remind us on how to decide whether to convert or to redeem our convertible debenture or loan or debt? Anybody? We did this last week. Okay, let me just take you there. See it here. Convertible debt. Convertible
It's
debt.
the IRR of conversion value.
IRR, okay. Pick, see the notes here. Pick the IRR between the redemption value or conversion value. Redemption value, examiner will state it for you most of the time. Worst case scenario, they will tell you that is at par, at premium, or at a discount. That's for redemption value. But conversion value, this is the formula: conversion price multiplied by conversion ratio. Conversion price is the share price in the year of conversion, and the conversion ratio is the number of shares per debt on conversion. So you do this. Once you do this, you know which one is the higher between your conversion value and the redemption value. Okay, so let's go and try that. For us to even know, we have convertible debt, right? Oh. Okay, we have convertible debt. So before you can even calculate your cost or your cost, you need to understand which method are you using. Are you using redemption? Are you going to redeem it, or you are going to convert it? Are you on the same page? Okay, so this should be the convertible debt. So we said pick higher of redemption value and conversion value. So let's go. Redemption value from that question. Let's quickly look at it. Okay, look at it again. This is the redemption value. If not converted, the stock will be redeemed in 4 years' time at a price of what? 125 naira. So it means our redemption price is 125 naira. Are you on the same page?
Yes, sir.
125 in 4 years. Then let's check conversion option. Conversion value, we said, is equals to share price in the year of conversion multiplied by number of shares per debt on conversion. Okay, so let's pick these guys, then we look at which one we are doing. Share price in the year of conversion. Let's check out for that first. Okay, there's it. The convertible debenture stock has a market price of this. The stock is convertible into ordinary shares in 5 years, okay, at the rate of 100 naira nominal stock for 50 ordinary shares. This 50 now is our number of shares per debt on conversion. Okay. Then the market price of the share at the time of conversion is expected to be 5 naira, 4 naira each. So 4 naira is the share price in the year of conversion, while 50 is the number of shares per debt on conversion. So we say this one is 5 years, 4 naira, right? Multiply by 50, I think. So this should be, so what do we have? This is 200, right? 200 naira. Any question? This is our conversion value. Conversion value. Any question?
No, sir.
We are told to pick the higher between this guy, So which one is higher? Higher
200.
is 200 naira. So we are converting. And our N will be 5 years because that's the conversion options. Any question from this end? Any question? No question. Okay.
Sorry, please. Sorry.
You are picking conversion option. Yes, I'm with you.
Yeah, that 50, what do you multiply with it? That this 200, what do you multiply? You multiply something with 50 to get this 200. I think.
Yes, it's the share price in the year of conversion. Check your material. That's 4 naira. Quick one. Let me show you what I'm saying. See it here. The market price of the share at the time of conversion is expected to be 4 naira each. Are we together?
Yes, yes.
Okay. So since we are converting, we are using the conversion option. Don't forget our market price of the debt is 120. Is this price X interest or not? Okay. We are told there that the company has just paid the interest for 2017 on all bonds except the irredeemable bond. Please be careful once we get to redeemable. And the tax rate is 25%. Okay, so let's go back to our note. Our market price of the debt is 120. Okay. So let's do our market price of debt first. Market value of debt for convertible. Now, I know we are doing convertible debt now. What's the formula again? It should be market price per debt X interest multiplied by number of debt, right? Okay. Our market price per debt, we were told that it is 120. Is it 120? Let me confirm. Yes, 120. See it here. Okay, let's look at the number of debts. So I have to go to the book value now and convert it. We are dealing with convertible debt, the one with 6%. That's even let me go back to the table and put 6% convertible debt. Okay, we have 150 million. Okay, so let me show you something before we proceed. There's that. The conversion, what's it called, is 100. Let me now go back to the solution. So our number of debts should be book value, which is that, I think 150 million baht. 150 million.
Yes, 150 million.
Divided by the par value of this
100.
debt is 100. Any question on this? Any question? So what's the result? Oh yeah, let's multiply.
180 million.
180 million. Please, let's always confirm figure. Once I write any figure in that table, I will not clean it. So let's always confirm figures so that in case there is a oversight, we can easily correct that before going too far. Okay. Are we good? Hello.
We are good, sir.
Yeah, we are good, sir.
Okay, these are market value of the debt. So we go to the table and we dump that there. Where's the table? 180, right? So we need to do the other one, which is this one is 6%. 6%. Okay. So we need to do the cost. What's the cost? What's the formula for the cost of the convertible debt? Anyone?
That's KD is equal to IRR. We use IRR.
Okay. KD is equal to IRR. So cost of convertible debt is equal to IRR, which is the KD. So who can help us with the IRR table again? If I have to do our IRR table, how is it going to look like? We have here. We have description. We have the cash flow. Then we have the first. So if you are doing, you are doing two different rates. First DCF, then you have your first PV, then you have your second DCF, you have your second PV. Any question? No question. Year zero. This conversion options, how many years? 5 years, right?
Yes, 5 years.
5 years. So year 1 to 5. Year zero, the owner of the bond will give out what we call the market price of the bond, market price of the debt. It's an outflow is 120 from this question. This guy here, please pay attention. This is the market price of the debt. This guy here, this 120 here. In year one is going to be negative because the owner of the bond will give that out. Okay. This one is interest 1 minus t. What is the interest rate on this convertible debt?
6%.
Anyone? Sorry, I didn't get that.
6%.
How many percent? How many percent?
6.
Okay, yes, see it here, 6%. Okay. 6%. Then to get the interest, that is the interest rate. Okay. So that's the interest rate. So interest is equals to interest rate multiplied by our par value, which is 6% multiplied by 100 naira, which is 6. Is that 6 naira, right?
Yes.
6 naira. So you now say 6 naira net of tax. What's the net of tax of this figure? Into 1 minus 0.25. The tax rate, quick one, I think is 25%, if I'm not mistaken. Let's go back. Our tax rate is 25%. See it here. The companies pay corporate tax at the rate of 25%. Are we on the same page? Are we together?
Yes, please.
Okay. So our tax rate is 25%. Okay. Then year 5 now, it is the conversion value. Conversion value. And we agree that is 200, right? Hello. So now our DCF, we assume 2 different rates. Okay. So which one should we use first? Should we use 5%? Let's try 5 and 15. So that we can get one positive and one negative discounting factor. What's it called? MPV rather. Or PV, you call it, whichever one. Okay. So DCF at this one is at 5%. Then this guy should be at 15%. Okay. Okay. So are we on the same page? What's our 5% year year 0? No matter the rate in year 0 will be 1.000. Am I right? Please let's respond. Okay.
You are right. You are right.
Yes.
Okay.
You are right, sir.
So we multiply the 2. For us to get our PV for this market price per debt under the first PV, you multiply the cash flow, which is 120 minus 120, multiplied by the DCF, which is minus 120. Okay. Let me quickly write something up here. Okay. Okay, here We have two types of discounting factor. We have the single period DCF. The formula is 1 plus R raised to power minus N. So we have a single period, use this, and we have home DCF multi-period. So the formula is 1 minus 1 plus R raised to power minus N, everything over R. Are we on the same page?
Yes.
Yes, sir.
So somebody should do 1 to 5 years now. 5%, 1 to 5 years. 5%, 1 to 5 years. Using the second formula, the
4.3.
formula. What do we have?
4.329.
4.329. Please, let's confirm figures. 4.329. When you multiply this with 6 net of tax, what do you have?
$19.48.
Okay, just a minute. I want to do something here. This is 6 into 1 minus 0.25, which will give us, somebody should do this for us first. What is 6 times 0.75?
4.5.
4.5, which means we are multiplying 4.5 multiplied by 4.329. What do you have?
19.48.
19.48. Okay, this one, year 5, you do DCF, single DCF. 5% year 5.
0.784.
784. If you multiply this with 200, what do you have, please?
156.8.
156.8. Okay, someone should add up this while other people should start this second DCF. Second DCF. What do you have?
56.28.
56.28. Positive or negative?
Positive.
Okay, so let's go. I hope people are confirming these figures because I won't come back to them. Okay, so let's proceed. For second DCF, for 50% here, will still be 1.000. If you multiply this with the cash flow here, you have minus 120 for year 0. Okay. Then for year 1 to 5, your interest. Let's get what is the discounting factor? 50% year 1 to 5. What do you have?
3.3.
3.352. 352. Let's multiply 3.352 times 4.5. What do we have?
15.08.
15.08. Okay. Then year 5. 15% here, 5, what do we have?
0.497.
0.497. Multiply by 200, what do we have?
99.4.
99 point what, please?
4.
12. So let's add up.
52. Positive.
Sir, it's 99.4, not 0.12.
4.
Just a minute. Point 4.
Yes, sir.
Okay. So what do we have?
5.52.
5.52. Positive or negative?
Positive.
Okay, that's not an issue. We'll work with that. But if you want a negative MPV, you increase it more than 15%, you get that. Okay, so this is
Hello, sorry, sir. The
MPV.
second one is negative.
It's
Sorry.
negative. It's not positive.
5.52 negative, sir.
It's negative.
Okay, so be sure of your figures, because if you are to use positive now, you're having different something. MPV, MPV IR rates. Okay, so since we have all this table now, we can now go back. What's the formula for MPV, please? For IRR. We said IRR. You know, these are KD actually. Just a minute. These are KD. We said KD is equals to IRR, and IRR is equals to lower rate plus MPV lower rate divided by MPV lower rate minus MPV higher rate multiplied by higher rate minus lower rate, right?
Yes.
So what is our lower rate? You have 15, you have 5% and you have 15%. Which one is lower? Oh yeah,
5%.
5%.
You see 5 plus MPV lower rate. That's MPV at 5.
56.28.
56.28 divided by 56.28 minus, this is the minus here. MPV rate is also minus. So minus, we cancel minus, we come plus 5.52 multiplied by higher rate 15% minus lower rate 5%. So let's do the calculation. What do we have? What do we have, please?
14%. 14.1.
People should be coming down now.
So I didn't get that. How many percent?
Let me calm down.
Which one is calm down there?
Sorry.
Which one is calm down there? Are you going to sleep here? Press your calculator now. This is a calculator thing. 14.1, right? Don't worry, you have the note. You can go over it and practice on it. Okay, that's why we chose this question, to cover all possible way of all the source of capital actually. Okay, Convertible debt, we are done with this thing, 14.1%. Let's go back to the question. So we are done with where is it? We are done with this convertible debt. Are you on the same page? Okay, now we are here now. The unsecured loan stock has a market price of 18 naira and is redeemable at par in 6 years' time. The market price of the irredeemable bond is okay. They are done with this one. This one is another type of debt. So let me take you to the table once again. See this unsecured loan stock. We don't know, we are not clear about its status. Is it redeemable? Is it unredeemable stock? So examiner have clarified that in this statement by saying that the unsecured loan stock has a market price of 80 naira and is redeemable at par in 6 years' time. Are we on the same page? Okay, so we go back to the calculation. 8% redeemable debt. If I may ask, what is the formula for the cost of redeemable debt? What's the formula for cost of redeemable debt?
Equal to KD is equal to IRR.
IRR again. Wonderful.
Yes, sir.
So we have yes. But let's pick the variable. Let me just leave 2 lines. So the interest net of tax is equals to, okay, let me just do, people will ask, I start asking me that the other one will put net of tax, this one, what happened? Is equals to 8% multiplied by 100, which is 8 naira, right? Okay. Tax rate is equals to 25%. So let's go to the table. Yes. Okay. Here we have description. We have the cash flow, first DCF at 5%, first PV, second DCF at 15%, second PV. Okay. Please, let's confirm that we are on the same page.
Confirmed.
Okay. So this is the IRR table. IRR table. Okay.
jẹ́ èèyàn tó jẹ́ kó máa kọ.
Hello, Oladele, can you mute your mic, please? Thank you. Okay, so this irredeemable years, how many years is it? N is equals to what? Let's go back to the question quickly. Where are we at? 6 years time. N is 6 years. 6 years time. Market price is 80. 8% at par. Okay. N is 6. Market price of the debt is 80. Okay, so here's a market price of debt 80 outflow. This one is 1.00. You have 80 negative. Year 1 to 6 interest net of tax, which is 8 into 1 minus 0.25. Somebody should do this. What do we have?
6.
Yeah, 8 into 0.75. What do you have?
6.
6.
Yes, please.
Okay, so let's do 5% year 1 to 5. What do we have? Year 1 to 6 rather. 5% year 1 to 6. You can check this at the back of your formula sheet.
5.076.
5.076.
5.076.
5.076. 076. Okay. So let's multiply 6 multiplied by 5.076. What do you have? 35. 30 times 30 point what?
30.46.
30.45.
30.45. Okay, year 6, we have the redemption value because this is a redeemable debt. Redemption value. Who can tell us the redemption value? What's our redemption value, please? Hello?
100.
Okay, so how do you write out at the 100, please? Quick one, see it here. We are told that.
Hello. The redemption. Hello, sir.
Yes, sir.
The redemption value of the redemption value of debt can either be 100 or 1,000.
No, that's wrong, sir. You mean par value, nominal value, face value may be 100 or 1,000. Is that what you meant to say?
Yes.
Then the value may be at par or at premium or at a discount.
Okay.
So in this case, we are told that it is at par. See my pen here. It's at par. It's redeemable at par. Are you on the same page? Then when you look at your market price of debt, is 80 naira. Between 1,000 and 100 naira, which one is closer to 80? Is it not 100? It's 100. So we assume that the par value of this debt is 100. Let us assume market price is 800 naira now. It means my par value should be 1,000 naira. Are you on the same page? Don't worry, when you get to bond valuation, you get this understanding better. Okay, let's proceed. So please, it's 3 things, either of the 3 things, either at par, at premium, or at a discount. So this is 100. What is 5% year 6? Single period, year 6. 0.46.
746.
746. So this should be 74.6. Then you multiply this with 100. So let's go to the second this here. 5% 15% rather, 15% at year 0 will still be 1.00. We still have 80 negative here. Okay, before that, let's quickly add up. Somebody should add up. What do we have here, please?
$25.06.
25.02.
6.
06. Positive, right? MPV over it. Okay. So what is 15% year 1 to 6?
3.784.
3.78. Multiply by 6. What do you have? By the cash flow.
22.70.
22.70. Then 15% year 6. What do you have?
0.432.
Multiply by 100. 43.2, right? So let's add up.
14.1.
14.1. Negative or positive, please?
Negative.
Okay. Our KD is equals to IRR is equals to lower rate plus MPV lower rate over MPV lower rate minus MPV higher rate multiplied by higher rate minus lower rate. So figure lower rate 5%, right? Plus MPV lower rate 25.06. Okay, divided by 25.06 minus that's plus 14.1.
My book, Joe.
Minus 5. Okay, so what do we have?
11.4%.
11.4%. Okay, go to the table. You say 11.4%. Do the market value of this debt too. Okay. Let's go to the workings. Market value of debt is equals to market price per debt x interest multiplied by number of debt. So let's go back to the question. The market price is 80. Then what's the number of the debt? Number of the debt is 300 million over 100. Okay. So 80 multiplied by 300 million divided by 100 So what do you have, please? That 240.
240.
Hello, is that 240 million?
Yes, sir.
So that's a market value of debt. But this one is 240. We say 240 million. Okay. Next one. Okay. So we stopped here. Let's proceed now. Done with this one. The market price on the irredeemable bond is at par. Okay. The company has just paid the interest for 2017 on all bonds except irredeemable bond. Okay. At par, and the bond is irredeemable. Okay, this is the 9% irredeemable bond. 100 million. Okay. Okay. So let's go back to the solution. Okay. 9% irredeemable debt. F 9% here. 9% 9% irredeemable debt. We are told that the market price of this debt is at par, cost to par equals to 100. So interest will be 9% multiplied by 100 naira, which is 9 naira. If I may ask, what is the cost of irredeemable debt? KD is equals to what? Anybody?
Interest over market value.
Interest net of tax
Of tax over market
per
value.
market price per debt x interest times 100. So let's put in those figures now. What's our interest? Is that 9 into 1 minus 0.25? Okay. Divided by market price per debt x interest. Let's go back to the question. Oh, we are told that, see it here, the company, the market price is 100 at par, but the company has just paid the interest for 2017 on all bonds except the irredeemable bond. So this market price at par is cum interest. Are we together?
Okay.
So let me just do it here. Market price per debt cum interest is equals to this x interest. X interest is equals to market price per bond cum interest minus interest, which is 100 minus 9, right? Which is 91 naira. So this is 1 naira. Okay, this is 9, it's 91. So KD is this guy. KD is equals to, what's the final result for this? Hello? Are we still together or am I on my own?
7.4%.
7.4%. Okay, let's do market value straight. Market value of debt is equals to market price of debt x interest divided by number of debt. Okay, this guy is 91 naira multiplied by, this is book value over par value. Let me pick the book value, just a minute. The book value of this debt is 100 million. So this we cancel. That should be 91 million, right?
Yes, sir.
91 million market value of debt. So 91 million, 7.4%. Let's go there. 91 million, 7.4, right? Percent. So don't think you have any other debts again. Okay, you are done with this one. The shareholders complain bitterly that blah blah blah. Okay. Okay, so go back to the table and complete our work now. All we do is that for this average total, you will say for equity, you say 1,400 multiplied by 36.5%. So what do we have for each of them like that? Okay.
Equity is 511.
511.
The first one.
511 equity. 511.
511. The second one.
12.
Let's maintain 2 decimal places.
12.
This one is what? 12.
Yep.
Next one.
25.3.
25.4.
0.38. Next one.
Okay, 20.
27.3.
0.3 what?
36.
So what about the first one? Is it 511.00?
No, just yes.
The last one.
6.73.
6.73. So let's add up. What do you have? Add up from here, from 511 to this place. Somebody should add up this one to all the market value. Then we get our work. Okay.
I mean, I give you now.
You said? Hello.
The average total is 582.47.
582.47. Then the market value is what?
Total market value.
1991.
1991.
1991.
Okay. So we have our WACC, which is, we call it KO, actually. KO, physical capital, is equals to 582.47 divided by 1991 multiplied by 100. So what do we have?
29%.
9.25.
29.
29%.
I can't hear you guys listen. Say.
29.
5.26.
0.2 what, please?
25.
Okay.
26. Approximately 26. 29.26.
Okay, so these are our okay. Okay, so let me tell you something now. If you look at all the various costs of capital, you discover that we have from equity is 36.5, preference shares 15, convertible debt 14, redeemable debt 11, redeemable debt 7. But when you compute the WACC, weighted average is 29.26. So what is the lesson here? The lesson is that when you are done with your WACC table, you can easily know maybe you're right or wrong yourself. If your WACC result is more than your cost of equity, if your WACC is more than cost of equity, something is wrong. It should be lower to that cost of equity, but it's going to be more than cost of debt. Are we on the same page? Are we on the same page?
Sorry, recap on that.
Okay. I said when you are done with your WACC figure must always be lower compared to the cost of equity, because cost of debt is cheaper. So if you are done calculating your WACC and you discover that your figure is more than cost of equity, that calculation is wrong. You have to check where you miss it from.
Sir,
Okay.
So does it also apply to cost of preference shares?
No. Cost of equity.
Okay.
Okay. So we are done with requirement question 1A. Can we proceed to question 1B now? So it doesn't mean you have all this in a question, in an exam. You just pick this comprehensive plan to show you how to deal with each of those different methods, source of finance, actually. Are we together? So let's go to question 1B. Calculate the cost of equity using CAPM as advised by the finance director. What's the formula for CAPM again? Somebody should remind us. KE is equals to risk-free plus beta into RM minus RF. Okay. So let's go there. You have all those stuff. They are all here. They are inside here. Okay. KE is risk-free. From here now, we are told that the average market return, this is the market return. This is our RM. RM is 23%. Return from treasury is 8%. This is the risk-free. Return from government bond. Why the systematic risk of the company has been as 120 of that of the market. So this is 120 over 100. This 1.2. Then we go to our calculation. Okay, cost of equity using CAPM. So KE is equals to risk-free plus beta into RM minus RF. Salam alaikum. Just a minute, sorry. Hello? Yes, I'm still at work. When I come back, I'll let you know. Yeah, not good. Sorry, that's my direct now. Okay, let's proceed. Now, risk-free, we said this return from government security. This is 8% from here. Return from treasury. So you just pick and dump approach. No stress. 8% plus beta is this guy is 120 over 100, which is 1.2 from that. Have 1.2. Then RM, I think that should be 23. Let's confirm. This is it. RM. Yeah, 23. 23 minus 8. You can even remove this percentage. When you are done, you put the percent back.
Excuse me, sir. Why is the beta 120 over 100?
Okay, we are told that it's 100% of that of market. Market is 100%, which is 1. So beta is 120% of that of the market. See it here. 120% of that of the market. Okay. So normally going forward, the beta you are going to be saying is in decimal point, like 1.2, 3.4, those stuff. Okay. So, figure, what do you have here? What do we have? K is equals to what?
26%.
20?
6.
I can't hear you.
Oh, mine is very low.
26.
26%. Okay. Thank you. Sorry. But if you check the first method, we arrive at K should be easy 36.5. Which means if you have used the dividend valuation model, your cost of capital will be higher if you use CAPM because of the higher rate of our cost of equity from that method. Question 1C, let's go there. Calculate cost of equity based on Gordon's model. If I may ask, is Gordon model a method of calculating cost of equity?
No. Growth.
So it's a method of calculating growth rate. Which means what I want you to do here is that we want you to calculate cost of equity, but using dividend valuation model, but your growth rate there should be from Gordon's growth model, not dividend growth model. Do you understand? So Gordon growth model is just a method of calculating growth rate, not equity. So our KE will be dividend year 0 into 1 plus G for market price per share X div. Okay, plus G, then everything over 100 over this divided by market price then times 100. But what we're saying here is that the growth in this formula now, examiner wants us to use Gordon's model. Did you get that? Yes. Any question?
Yes.
No. Okay, let's go. According to Gordon's work model, let me put every other thing and put this back. Our dividend is 0.7. I still remember this. To 1 plus G into 1 plus growth rate over market price. Was it 2.8 the other time? Then we close this, say plus the growth rate, then everything multiplied by 100. Okay, so we need to get the growth rate. Growth rate is equals to Gordon's model, which is R multiplied by B bar. We said this formula simply
Sir, please scroll up. Sir,
return
please
of
scroll up.
investment.
Scroll up your screen. Please scroll up your screen, sir.
Like this?
Yeah, up. Yeah. Just scroll up.
Where?
No, like scroll up. Like what you're writing now is down. It's bottom of my screen. Yeah,
Okay.
Thanks. Yeah.
Okay, I get it now. Okay. Can you see it now?
Yes.
So return on investment multiplied by retention ratio. Retention ratio. Okay. So what is the formula for return on investment? Hello.
Profit after tax over capital employed.
Multiplied by 100.
I didn't get that.
Profit after tax over capital employed multiplied by 100. Hello, sir.
I can hear you now. Okay. Then
So
what
profit
is
after tax?
Yes. Then what is now the retention ratio formula?
We take NE over part multiplied by 100. Hello, sir.
I can hear you. Okay.
We take NE over part
multiplied
by 100 over 1.
Okay.
And our retained earnings is part minus dividend.
Okay. So I said it the other time. You can check the former notes. I said yes, you can have the percentage for the ROI, and you can also have what we call the retention ratio, which is payout. This is 100 minus payout ratio. Okay. So let's go to the question to know what we have. Okay. See it over here. The company usually reinvest. Okay. Okay. The company usually reinvests. Its retained earning. They have a payout ratio of 24%. So if I'm paying out 24% of my profit as dividend, how many percentage are we retaining like that? That's 100 minus 24. Are we on the same page? And the average return on investment of 25%. So our ROI is 25% and our payout ratio is 24%. So we say G is equals to 25% multiplied by 100 minus 24. Okay. Yes, so let's go back. This is 25% multiplied by, is that 76, right? Percent. So what's the growth rate? Hello?
0.19.
That's 19%.
19%.
Okay, this is what we are told to do actually. If you look at the requirements, calculate the cost of equity. Okay, cost of equity based on Gordon's model. Let's go back to Gordon's model. Cost of equity order. We have the growth rate 19%. We go out to the cost of equity now. 0.19. 0.19. So figures what our cost of equity using this method. Oh yeah, figure. Figure.
I have 48.75%.
14.
0.75%.
14.
48.
Okay.
48.75%.
48.75%. Yeah. Any contrary figure, so this is what we are told to calculate. So Gordon's model is not a method of calculating cost of equity, but it's a method of calculating growth rate if you are to use dividend growth model to calculate cost of equity. Okay. Question 1D. Okay. What's that requirement again? So is it
Analyze the finance director statement.
Analyze finance director statement. Risk profile. Shareholders' complaint should be included. Okay. What's in statement? Okay, yeah, this area, this place. Finance director is not satisfied with the cost of capital figure calculated. He believes that capital asset pricing model is preferable to dividend valuation model approach, and is also of the view that Gordon's growth model be adopted in determining the growth rate associated with the dividend. Okay, let's write. So, like you can say, the finance director's comment, the finance director's comment on the issue of CAPM being preferred to dividend valuation model is realistic. And the only reason is that CAPM actually consider risk, the whole market risk, as CAPM consider considers risk. Okay. Consider risk, the whole market, and value security based on the other factor aside dividend. Okay. Then the growth model to be used actually depends on organization preference between dividend growth model and Gordon's growth model. Because of when you get to dividend policy, you understand this better. So the growth model to be used
But for 40.
Sorry, I didn't get that. So you can, for the shareholders now, the shareholders, since there's a point whereby they say they complain about dividend, let's confirm that first. Okay. The shareholders see this point, complain bitterly on the 2016 dividend of this as it was lower than what other similar companies paid as dividends. So let's do this. The shareholders complain we feel that they prefer dividend, and so it will be of great risk for the to the company to double star if the dividend policy. When you get to dividend policy, you understand this better. Policy is not competitive. It's not competitive.
Sorry, sir. Please come down a bit. You've not written the top.
Can you see it now? Okay, you said it's not written.
Not yet, sir.
I didn't get your question.
The upper part. The upper part.
Yes. What happened to it, ma'am?
I've not written it. I'm still writing it.
Oh, so I didn't tell you guys. You don't write when we are in class. You can only just important points. Then the note will be shared on the group. So you just for you to print and go through it. No need to write like that. Yeah.
Oh, thank you.
Okay, so you're welcome. That's all on this question. go through it against next if you have any challenge before we proceed. Okay. So tomorrow is I think Thursday. Over the weekend, try on the question. You have other questions there. But go through the first one we saw because this one is very comprehensive compared to other questions there actually. And once you can solve this on your own, you are good to go for this topic. And the good thing is that this is the double entry of SFM. Yeah, cost of capital is the double entry of SFM. You keep on meeting this in any of the topics whereby you are going to work with cash flow when it comes to discounting it. You see, some of them, or most of them will not be as comprehensive as this because it's not the only thing they are testing there. So any question before we call it a day, please? Let me try. Can I drop this on the platform? Any question? Any question before we call it a day?
Okay. Please, hello.
I can hear you, sir.
Yes, I would like to thank you very much for this lecture you have taken us through, and even the approach you are giving to us to solving this question. My question is on the dividend growth, where we are using a payout ratio and retention. I would like to ask, in a normal examination questions,
yes, sir.
Because now I could see that we just apply based on what we have in this question, that they have a payout ratio of 24%, and the average return of investment, without applying the initial formula that we had. We just apply it straight based on the demand of the question. My question is that, is this only way that this kind of question will be tested? Because this was looks the simplest to apply that formula that we already learned last week.
It looks simple because I solved it for you guys. If I say people should close their book and try it, you see that it's not simple. Don't worry. So the thing is this.
Okay.
First, three things you need to learn SFM. Or should I say first? First of all, you need to understand the topic. Topic, not even the question. Topic first. That's why we took the whole of last week explaining this. You understand? If I want to rush and solve 5 questions, there's a way we normally do it, but at the end of the day, you see that you've learned nothing. You won't know after the class, you'll be thinking your note is up to date, you're able to copy everything. But when they say, yeah, close your book, you can even say open your book, yeah, try a question. You will just be looking. You see? So, and we don't want that to happen. That's why we want to take it slow. Okay? First thing is understanding of the topic, which means if somebody missed last week class, the person needs to go through that last week note first. Because if you go through this note here, you're just doing yourself, because this one is just a soft question here. The note to the topic is not here. So the person needs to go through that last week note. So you understand the topic first. After the understanding of the topic, then the requirement of the question matters a lot. You have to understand what is required of you to do. Because if I ask you to do growth rate using Gordon's growth model, and you finish that, you now proceed doing cost of equity, you even proceed doing the WACC, because you have the information, you are just wasting your time, because there won't be any mark for that. So you have to understand how to interpret the requirement. You have to have the understanding of that. If it will take you 5-10 minutes to interpret and understand it, it's very important. Then aside that, now, after you have the knowledge of the topic, the understanding of the requirement, then you need to know how to bring out your variables from each question. When I say variables, I mean what make up the formula, because you discover that what we are doing, most of them is formula based. So the first thing, once you can write down the formula, then look out for the variables. Then once you can do that, just keep on practicing. I normally advise students, before you even go to another question, close your book. After studying the one we did in class, close your book. I didn't say you should do audit though. Close your book, then try to solve the one we solved on your own. Okay? Solve the one we solved without looking at your material. If you can do that, it means you have at least 50 to 60% of the understanding required for that topic. But I didn't say you should now say, okay, after you've hung, you don't know where to go. The next step, you now say, let me open my notes. Let me see how we do it. Okay, here it's like this. You continue. That one, you're just doing auditing. You're auditing your notes. You're not practicing. So that's another thing I want to tell you is that if you have a textbook, just stick with that textbook. It's enough for you. Don't go and be gathering like 5 different textbooks that you won't even end up reading them. Because the funniest part is that when you use 2 different textbooks, for example, now I don't want to mention textbooks name. All textbooks are okay for me. They are good for me. But what I'm saying is this: if you are using SFM Pack or Omoleyiwa or Workout, different names, sort of names, they have different approach to different topics. So if you are using Omoleyiwa, stick to Omoleyiwa. If you are using Workout, if you are using SFM Simple, different one. So stick to the material you are using. After the class, after the understanding of the notes in the class, if you want to read more, go through your material. But if you see that at the end of the day, all we are going to see in that material is what we discuss in class. So practice make perfect. First point of practice, after the understanding of the one you solve in class, close your notes, try to solve that same question on your own. Then you will now see some points that they are the key point that you need to be careful with. So that's my advice. Any other comment or question before we call it a day, so that I can go and rest at home too? I've just dropped the solution in the group. It's on the group now. Our today's notes is on the group. Okay. Are we together?
Yes, sir.
Okay, so I think you can call it a day if there is no any other addition or subtraction or question. Because right now I'm in the office, a mosquito is dealing with me.
Oh, sorry. Thank you very much for your patience and for taking us through it. Thank you very much, sir.
You're welcome. You're welcome.
Thank you very much.
Thank you very much, though. Really appreciate it so
Okay.
much. Very interesting.
So try and go
Thank
through this before
you.
next class. Because
Thank you.
next class I'm moving to adjusted one. I will share the material probably on Monday. Because I have other class
Thank you very much, sir.
Friday. Okay now. Let's thank God.
Good night.
So enjoy the rest.
I need to good night.
Yeah, good night.
Sorry, what topic did you say we are moving to?
Adjusted work.
Okay. Thank you very much.